All right, welcome in everyone. Today we're going to be taking a deep dive into Genting Malaysia Berhad.
Ooh, Genting.
Yeah, they're a big player in the global leisure and hospitality industry.
For sure, for sure.
Yeah, we've got a lot to unpack here. We've got their 4Q24 press release, their annual report,
Okay.
and we've got 3 analyst articles that we're going to be kind of dissecting and piecing together.
Sounds good.
And what's interesting here is that we've got a little bit of a puzzle. Their revenue is up, but profits are down.
Really?
Yeah, so that's kind of one of the things we want to dive into and figure out what's going on there.
It's interesting.
And then there's also just a little bit of kind of legal drama happening
Ooh, fun.
with their Bahamas resort. There's a shareholder lawsuit that's kind of swirling around.
Oh, wow.
So we'll get to that a little bit later.
Okay.
But yeah, let's just jump right in. So first of all,
Yeah.
revenue growth. They saw a 7% revenue growth in FY24.
Okay, that's great.
Which is pretty impressive. They hit RM 10.9 billion.
Wow, that's a big number.
Yeah, and this is despite, a really volatile global economy right now.
Yeah, it's pretty crazy out there.
We've got geopolitical tensions, trade frictions.
Yeah, all of it.
So the fact that they're still seeing growth is pretty impressive.
Definitely.
And it looks like this growth is fueled by increased business volume across all their regions.
Okay.
So Malaysia, the UK, Egypt, the US, Bahamas.
Wow, they're all over the place.
They are. They're a global company.
Yeah.
And they even specifically call out Resorts World New York City as being a key driver.
Oh, really?
Yeah, of that U.S. revenue boost.
I mean, New York is a huge market,
Right. Exactly.
so that makes sense.
Yeah. So far, so good. But here's where things get a little interesting.
Oh.
Despite that revenue surge, their net profit actually declined by 55%.
Oh, okay.
To RM 162.1 million in FY24.
That's a big drop.
Yeah. And to make matters even more interesting, they actually recorded a net loss in the last quarter.
No kidding.
Yeah, of RM 485.6 million.
So they're making more money but ending up with less? How does that even work?
Yeah, it's a good question. So let's unpack that a little bit. So one of the big things here is that they had some unfavorable foreign exchange rates.
Oh, okay.
They hold a lot of US dollar denominated debt.
Huh.
And those recent currency swings, those hit them hard.
Yeah, you can imagine.
Especially in that final quarter.
So even though their revenue was up, the actual value of that revenue was kind of being eaten away by those exchange rates?
Exactly, yeah.
Yeah.
So that's one piece of the puzzle.
Makes sense.
Now, even if we back out those foreign exchange losses, there's still some underlying issues that they need to address.
Oh, okay. What else is going on?
Yeah, so one thing is their operating expenses.
Yeah.
Those have gone up across all their business segments,
Oh,
particularly in Malaysia,
okay.
and that's impacting their overall profitability.
And that makes sense, right? If costs are up, profits are going to be down.
Exactly, yeah.
Yeah.
So that's something to keep an eye on. Also, one of the analyst reports pointed out that they had a pretty hefty write-off of property, plant, and equipment
Oh, really?
in FY24. These are considered exceptional items, but they can really take a bite out of profits.
Yeah, for sure. So what was that all about?
Well, it wasn't entirely clear from the report, but it's something that we'll want to keep an eye on and see if there's any more information about that.
Definitely.
And then on top of all that, they also made a strategic decision to bid for that new casino license in New York.
Oh, yeah. Heard about that. That's a big deal.
It is a big deal, yeah.
So how is that impacting their financials?
Well, those pre-opening expenses, those can stack up quickly.
Yeah, that makes sense. It's a big investment up front,
Exactly.
but potentially a huge payoff down the road if they get it.
Exactly. It's that classic high-risk, high-reward situation.
Totally.
And then speaking of investments, let's talk about that dividend drop.
Uh-oh, this doesn't sound good.
They actually slashed their final payout for FY24 to 4.0 sen per share,
Wow.
which is down from 9.0 sen the previous year.
Ouch.
Yeah, and investors definitely took notice of that.
Yeah, I bet they did.
Genting didn't explicitly state the reason for this,
Uh,
but it's likely tied to that shrinking profitability that we've been talking about.
right, with the foreign exchange losses, the rising operating expenses, and then that big New York bid.
Exactly. It's like they're trying to manage their cash flow
Makes sense.
in the face of all these, financial pressures.
So it's like a temporary belt-tightening measure.
Yeah, it makes you wonder, is it temporary? Is it a sign of something bigger?
Yeah, good question.
And that brings us to another area that I thought was interesting, operational efficiency.
Okay.
The data suggests there's room for improvement there.
So what does that look like?
Yeah, so while they are trying to streamline their operations,
Yeah.
there's still some work to do.
All right.
They're exploring things like using customer data more effectively,
Yeah.
revamping pricing structures, automating certain tasks.
Uh-huh.
But it seems like they're at least aware of the issue.
Right. They're not just sitting back and hoping for the best.
Exactly. So that's a good sign.
Definitely.
But even with all these challenges, they're not shying away from making bold moves for future growth.
Okay. I like that. So what are they up to?
So, for example, their U.S. expansion plan.
Oh, right. The New York bid.
Yeah, so they're really doubling down on their success in New York City.
Makes sense.
They want to expand their footprint, obviously, with those new casino licenses.
Yeah.
And New York City is a global travel hub, right?
Absolutely.
Huge tourism industry. So securing a license there could be a game changer.
Yeah, for sure. But it's a tough market, right?
Oh, yeah. There's a lot of competition.
Right.
Other major players are vying for those same licenses.
Yeah. So they're going to need to bring their A game.
For sure. It's like a high-stakes poker game.
Love that analogy.
Right. Everyone's betting big.
Yeah.
But let's not forget about their home turf,
Okay.
Genting Highlands.
Right.
So they're putting a lot of resources into upgrading that flagship resort. And their focus there is on ecotourism
Okay.
and new attractions. They want to transform Genting Highlands from this kind of casino-centric resort
Yeah.
into a multifaceted entertainment destination.
Oh, wow. So they're branching out.
They are. They're recognizing that people are looking for more than just gambling these days.
Yeah. People want experiences. They
Yes.
want something unique.
Exactly. And they want, sustainable travel options.
Right.
So they're capitalizing on the natural beauty of Genting Highlands.
Right.
They're adding ecotourism trails, adventure activities,
Cool.
and they're really trying to create this holistic experience for visitors.
I like that.
Yeah. So by diversifying their offerings,
Yeah.
they're not only attracting new visitors,
Right.
but they're also encouraging their existing guests to stay longer and ultimately spend more.
That's the goal.
Exactly.
Yeah.
And speaking of spending, let's talk about those 60th anniversary celebrations.
Oh, yeah. I saw something about that.
They're going all out with promotions and events,
Makes sense.
trying to revitalize their brand image.
Yeah. Anniversaries are a great opportunity to reconnect with customers.
Right.
And remind them why they love your brand.
Exactly.
Yeah.
And they're doing this at a time when international tourism is really rebounding after a rough few years. So they're really riding that wave
Makes sense.
of renewed travel enthusiasm.
Yeah, guide me.
But we can't ignore the legal drama that's brewing in the background.
Right. The shareholder lawsuit.
Yeah. That USD $600 million claim over their Bahamas resort.
Yeah, that's a big one.
It's a big one. And it could have a serious impact on their bottom line and their reputation.
For sure. Legal battles are always unpredictable.
Right. And a win for Genting, that could boost investor confidence.
Yeah.
But a loss, especially a big settlement,
Yeah.
that could really drain their resources.
Absolutely. So that's definitely something to watch.
Definitely something to watch. So we've covered a lot of ground here.
We have.
But I want to stop here for a second and bring this back to you, the listener.
Yeah. What stands out to you from what we've talked about so far?
What piques your interest?
What questions are popping up in your mind?
Genting's story is a good reminder that even these global giants,
Right.
they have to adapt and innovate to stay ahead of the curve.
Absolutely.
They're dealing with these economic fluctuations, legal challenges, and they need to constantly evolve.
Right.
I think what's really fascinating to me is this contrast
Yeah.
between their short-term struggles and their long-term ambitions.
Right.
They're facing these headwinds, but they're still making these bold bets on the future.
It makes you wonder, are they spreading themselves too thin?
Yeah.
Or is this just calculated risk-taking that will ultimately pay off?
Right. Good question.
These are the kinds of questions that we're going to be exploring as we dive deeper into Genting's financial performance in the next part of our deep dive.
Can't wait.
So, can Genting's bold moves really offset their current challenges? Can they really lead to sustainable growth?
I mean, that's the big question, isn't it?
It is. And we touched on their U.S. expansion a little bit.
Yeah.
But I think it's worth taking a closer look.
Okay.
It's not just about expanding, right?
Yeah.
It's about where they're choosing to expand in New York.
Right.
Global appeal, lucrative tourism industry
Yeah.
that represents a calculated risk for Genting.
For sure. So they're being strategic.
Exactly.
They're not just chasing any opportunity. They're going after a market with huge potential,
Absolutely.
but also one with fierce competition.
Oh, yeah, for sure.
So if they can snag one of those coveted casino licenses, that could be a game changer.
It really could.
It could boost their revenue,
Yeah.
their market share, really influence the U.S. gaming landscape.
Big time.
But it's not a sure bet.
Right.
They're going head-to-head with some other big players.
Yeah, who knows how that's going to play out.
So what's their strategy?
I don't...
What are they bringing to the table that's unique?
Yeah, what makes them stand out?
That's the million-dollar question.
Yeah, it is. Maybe they're banking on their experience with Resorts World New York City.
Right. They already have a presence there.
Yeah. Or their brand recognition. Maybe they're cooking up something totally new that we haven't even seen yet.
Right. Some secret weapon.
What to see?
It's a gamble.
Oh, yeah, for sure.
But let's shift gears a little bit and talk about those investments closer to home.
Okay. Genting Highlands.
Yeah, so they're trying to transform that from a casino-centric resort into a real multifaceted entertainment destination.
I mean, that's smart, though.
It is.
They're recognizing that people are looking for more than just gambling these days.
Right, exactly.
Like I said earlier, they want those unique experiences.
Yeah.
They want sustainable travel options.
Yeah.
Deeper connection with the environment.
Mm-hmm. And Genting is capitalizing on that, right? They're really playing up the natural beauty of Genting Highlands.
Totally. So what are they doing specifically?
Well, they're adding those ecotourism trails,
Okay.
adventure activities, creating a more holistic experience.
Right.
So not only are they appealing to a wider audience,
Yeah.
but they're also encouraging those existing guests to stay longer, spend more.
It's a win-win.
Exactly.
I like it.
And let's not forget about those 60th anniversary celebrations.
Oh, yeah. Those are in full swing.
They're really pulling out all the stops, trying to revitalize that brand image.
Yeah. I love a good anniversary celebration.
Right. It's a great opportunity to reconnect with customers.
Remind them why they love your brand.
Exactly. And they're doing it at a time when the global tourism industry is bouncing back.
Yeah, after a few rough years.
So, good timing.
For sure.
But amidst all this celebratory fanfare,
Yeah.
we can't ignore that shareholder lawsuit.
Right. That's still looming over them.
Yeah, that USD $600 million claim.
That's a big one.
It really injects a lot of uncertainty into their financial future.
Yeah, for sure. Legal battles, those are unpredictable.
Right. And they can be costly.
Absolutely.
And the outcome of this case, it could have a ripple effect on their entire operation.
So what could happen? I mean, what are the potential outcomes here?
Well, they might have to scale back some of their expansion plans.
Right.
Maybe make some tough decisions about how they're allocating resources.
Yeah, prioritize certain projects over others.
Exactly.
Maybe delay things a bit.
Right.
Rethink their overall strategy.
That's a big question mark.
Yeah.
So let's bring this back to the listener for a second.
Okay.
How does all of this impact you? Especially if you're thinking about investing in Genting.
Right. Or the gaming industry as a whole.
Yeah, so think about that.
It's important to look beyond the surface, right?
Absolutely.
Consider the bigger picture.
Mm-hmm.
So as an investor, you need to understand the company's vision.
Right.
How are they going to adapt to these changing conditions?
Mm-hmm.
How are they going to manage risk?
Yeah, it's not just about looking at those revenue figures.
Right.
It's about understanding the why.
Exactly.
And remembering that investing is a marathon.
It's not a sprint.
Yeah, a sprint.
You need patience.
Yeah.
You need to do your research
Mm-hmm.
and be prepared for those ups and downs.
Yeah, that's the nature of the market.
For sure.
And I think Genting's case really highlights the importance of diversification.
Totally.
They're not putting all their eggs in one basket.
Right. They're expanding geographically.
Yeah.
They're diversifying what they offer,
Mm-hmm.
exploring new revenue streams.
Right. It's a way to manage risk.
Absolutely.
Create a more resilient business model.
Be prepared for whatever comes your way.
Yeah, you got to be able to weather the storm.
For sure.
And capitalize on those new opportunities when they come up.
Totally.
And of course, due diligence is key
Always.
before you invest in any company.
Yeah.
Do your research.
Hmm.
Look at their financials, their management team, their competitive landscape,
Uh-huh.
any legal or regulatory hurdles they might be facing.
It's all part of the process.
It is.
Yeah.
And informed investors are better equipped to make good decisions. They understand that past performance doesn't guarantee future results. You got to stay informed.
Absolutely.
So now let's dive into another critical piece of this puzzle.
Okay.
Operational efficiency.
All right.
This is where we can really get a sense of how they're managing their internal operations
Okay.
and how they're controlling costs.
So what are we looking at here?
Well, even a global giant like Genting,
Mm-hmm.
they're still focused on optimizing those processes,
Makes sense.
streamlining things, making sure they're getting the most out of their resources.
Yeah.
And their press release specifically mentions strengthening their yielding capabilities.
Yielding capabilities, what does that even mean?
It basically means maximizing revenue from their existing assets.
Oh, okay, so getting the most bang for their buck.
Exactly.
So not just attracting new guests,
Right.
but encouraging the ones they have to spend more.
Exactly.
Okay, so how are they doing that?
Well, they're looking at everything from their pricing strategies to creating those personalized experiences that really encourage guests to open up their wallets.
Interesting.
And technology is playing a big role here.
Of course.
They're using customer data
Hmm?
to tailor their offerings, create those more personalized marketing messages.
So it's like those personalized recommendations you get online.
Exactly.
Based on what you've bought or looked at before.
It's all about creating a more tailored experience.
Makes sense.
And then streamlining processes. That's another key area.
Yeah, that's important for any business.
Big or small.
So getting rid of bottlenecks,
Yeah.
automating tasks, improving their agility.
Exactly. And technology is really key to this transformation.
Yeah. There's so many tools out there these days.
From cloud computing to AI.
It's amazing how technology is revolutionizing even traditional industries like this.
Right. It's not just about the back-end stuff.
Yeah.
It's about improving that customer experience, too.
Right.
Think about things like mobile check-in,
Yeah.
contactless payments, those personalized concierge services.
Makes everything so much smoother.
Exactly. It's all about removing those friction points.
Yeah. Make it seamless.
So Genting is really taking this multi-pronged approach.
Operational efficiency,
Yeah, combining that smart technology with those strategic process improvements.
but it's an ongoing process, right?
Yeah, it is.
It never really ends.
Yeah, the business landscape is always changing.
They're going to have to keep adapting.
Keep optimizing to stay ahead.
For sure.
So let's move on to another critical aspect of their financials, their capital structure.
Okay.
This is where we get a sense of how they're financing everything and how they're managing their debt.
So what's the story there?
Well, their financial statements reveal a pretty significant reliance on debt,
Okay.
particularly in U.S. dollars.
Uh-oh. We know how that's been going for them.
Right, those foreign exchange losses have really impacted their profitability.
Yeah.
And it seems like this debt burden is a bit of a recurring theme.
So is that sustainable?
That's a good question, especially with the possibility of those interest rates going up.
Yeah, higher interest rates mean higher borrowing costs,
Exactly.
which can eat into profits, limit their flexibility,
Right. So they're walking this tightrope.
trying to balance those growth plans
Yeah.
with the need to manage that debt responsibly.
Yeah, so they have a lot of USD-denominated debt, and they're trying to mitigate that risk of those currency fluctuations.
Right, I bet they are.
Their annual report mentions something called cross-currency interest rate swaps.
Cross-currency interest rate swaps.
Oh.
Now, those sound complicated.
They are a bit technical.
Okay, so break it down for me.
Basically, think of them like insurance policies.
Oh, yeah.
They protect you from losing money
Yeah.
if the exchange rates move in an unfavorable direction.
Okay, so it's like buying insurance on your house in case of a fire.
Yeah, you hope you never need it,
Right.
but it's there to protect you just in case.
Okay, that makes sense. So it doesn't eliminate the risk completely, but it can help soften the blow.
Exactly.
But even with those hedging strategies, can they really manage that debt effectively
Yeah.
while still pursuing all those growth plans?
It's a tough balancing act.
For sure.
So let's zoom out for a second
Okay.
and look at their overall financial health.
Yeah.
We've talked about revenue, profitability, operational efficiency, capital structure.
But what's the bigger picture here?
Yeah, so if we analyze their balance sheet,
Okay.
look at some of those key financial ratios,
Yeah.
a few things stand out.
All right. I'm all ears.
First of all, they have a substantial amount of assets.
Yeah.
They've got valuable real estate holdings, those resorts, those casinos.
That's good, right?
Yeah, assets are good.
Those are things that can generate income.
Exactly.
Yeah.
But on the flip side,
Oh.
they also have a significant amount of liabilities.
Primarily that debt we've been talking about.
Yes, exactly.
So it's a double-edged sword.
It is. It's like having a powerful engine in your car.
Okay, I like this analogy.
It can take you far and fast,
Yeah.
but it also requires more fuel and maintenance.
So that debt can fuel their expansion and growth, but it also makes them vulnerable
Right.
if things go south
Exactly.
or if those interest rates start climbing.
Yeah, so it's a mixed bag.
They've got strengths and weaknesses.
You got to weigh both.
Okay, so where do we go from here?
I think we need to dig a little deeper into those financials.
Yeah, get a clearer picture.
Let's look at some key financial ratios.
Okay.
Those can really shed some light on things like their liquidity, their solvency, their profitability.
Yeah, I'm curious to see what those numbers reveal.
Let's see if we can get a better sense of their overall financial fitness.
Okay, let's do it.
Okay, so let's talk about those financial ratios.
All right, yeah, let's dive in.
What can they tell us about Genting's ability to, stay afloat?
Well, a good place to start is with the current ratio.
Okay.
That gives us a snapshot of their short-term liquidity,
Short-term liquidity, meaning
meaning their ability to pay off their immediate debts using readily available assets.
so do they have enough cash on hand to cover their bills?
Exactly, yeah.
Okay.
Now, a current ratio of 2 or higher is generally considered healthy,
Okay.
but in the leisure and hospitality industry,
Mm-hmm.
a ratio of 1 or higher is often acceptable.
Okay, so where does Genting stand?
Well, their latest balance sheet shows current assets of RM 4.29 billion
Okay.
and current liabilities of RM 3.34 billion,
All right.
giving them a current ratio of 1.28.
So they're within the acceptable range,
They are.
but not by a huge margin.
Not a huge margin, no.
So it's not a screaming red flag,
Right.
but it's something they need to keep an eye on.
Yeah, definitely.
Okay, what about their long-term financial stability?
So their solvency,
Solvency, yeah.
we can look at their debt-to-equity ratio for that.
Debt-to-equity ratio, okay.
So this tells us how much of their operations are funded by borrowed money
Okay.
versus their own equity.
So the lower the ratio, the better.
Generally, yeah. Ideally below 1.
Okay.
Genting's latest balance sheet shows total debt of RM 12.22 billion,
Okay.
total equity of RM 100.04 billion,
All right.
giving them a debt-to-equity ratio of 1.11.
So a little higher than ideal.
It is.
Seems like that reliance on debt is a bit of a theme here.
It does seem that way.
So even though they have valuable assets,
Mm-hmm.
a big chunk of that is financed by debt.
Right, making them more sensitive to those economic shifts.
Okay, let's talk about profitability.
Right.
We know their net profit took a hit.
Yeah.
But let's look at their return on equity.
ROE.
ROE, right?
That tells us how efficiently they're using shareholder investments
Okay.
to generate profits.
So higher ROE is good.
Yeah, the higher the better.
Okay.
A benchmark of 15% or higher is usually a good sign.
Okay.
For Genting, their net income for FY24 was RM 162.1 million.
Okay.
Their average shareholder equity was RM 11.97 billion, giving them an ROE of just 1.35%.
Wow. Okay, so
Right.
significantly below that benchmark.
Yeah. Profitability is definitely an area where they're facing some headwinds.
They're not translating those investments into profits as efficiently as they could be.
Exactly.
All right, so we've analyzed Genting Malaysia Berhad's financial performance from a lot of different angles.
We have, yeah.
Revenue, profitability, operational efficiency.
Capital structure, overall financial health.
It's a mixed bag.
It is, yeah.
So what does this all mean for the listener?
Well, I think Genting's story is a great example of how even these big industry giants
Right.
face complex challenges in a global market.
Yeah, it's a dynamic world out there.
Exactly, and it shows the importance of looking beyond the surface level numbers.
Understanding what's driving that performance.
Exactly.
So investing, it requires careful analysis,
Oh, absolutely.
like a long-term perspective. You got to weigh the risks and the opportunities.
It's all part of it.
So Genting's diversification strategy,
Yeah.
their focus on improving operational efficiency, their willingness to make those bold moves for growth, those are all positive signs.
Yeah, for sure.
But that debt burden,
Right.
the profitability concerns, and those legal challenges, you can't ignore those either.
Nope.
So, as we wrap up this deep dive,
Yeah.
we want to leave you with one final thought.
Okay.
Imagine you're a potential investor
All right.
sitting across the table from Genting's CEO.
Okay, I'm listening.
What questions would you ask them?
Ooh, good question.
What are your key takeaways from all of this?
Yeah.
What do you think about their future?
I mean, this deep dive, it's just a starting point.
It is.
It's up to you to connect the dots.
Your own conclusions.
Keep exploring Genting Malaysia Berhad.
Keep asking those questions.
Absolutely.
So thanks for joining us on this deep dive.
Yeah, thanks for having me.
Until next time, keep exploring, keep questioning, and keep diving deep.